Hi, Michael Glennon from Glennon Capital. This week we're going to talk about executive remuneration. So it's a topical issue at the moment. We've seen a massive turnaround in the people voting against Macquarie Bank's executive remuneration. So last year, about 3% of people have voted against how much executives were paid. This year we've seen 15% of people vote against the remuneration at Macquarie Bank. So we all know Macquarie Bank historically, it's titled the Millionaire's Factory. It's made a lot of people very wealthy and a lot of people have been very well paid. People are starting to think that there's a little bit of ambiguity and less clarity about how executives are actually remunerated and how they get their money. Why that's interesting for us, we keep abreast of what's happening in how much CEOs and senior level executives are paid, because for small companies, quite often you'll see companies where the management and senior executives are paid significantly more than what's appropriate for the size of the business. So a good example, we look at many small companies that have a profit under $1 million. When you add up the total executive remuneration, and it's significantly more than what the company's making in terms of profit, it's a warning sign for us. So if you've got a CEO being paid $1 million a year and the company's only earning $500,000 a year, in my way of thinking, as an owner of the business, unless that guy's doing an absolutely fantastic job and positioning that business for long-term growth, maybe it's time to look at whether that CEO needs to be remunerated more through shares, or because he has a large shareholding and he thinks that his wealth will be generated from an increase in the share price, where he'll generate more wealth for himself than through executive salary. So it's a warning sign for us when we look at companies where management doesn't have a big investment in the business. They're paid a lot. They've got very generous executive share option plans or performance rights that are attached to hurdles that may be very low. We saw a recent example of that. Company that we thought was a fantastic company, very well positioned, doing great things in the marketplace. But there were many shares on issue as there were options and various different performance rights and things like that. So the company, when you fully dilute, was twice as big as what it initially appeared when you look at the market cap. So a little bit of further research undercovers shows up that it's not a great capital structure, and management's more aligned with making money for themselves through taking money off existing shareholders than they are in terms of growing the business. So that's a sign that we are cautious of. The other thing we try and do is talk to management if there are big changes in how people are remunerated and how much money they're taking out of the business, because it's crucial to the performance of a small and micro cap company when salaries can represent such a large proportion of the total profit that's coming out. So as I said, a couple of $1 million in wages versus less than $1 million in profit, it's a warning sign for us unless we think that management's fantastic. And it's good management, few and far between, which makes it hard finding small cap companies. So executive remuneration, topical subject at the moment, but it's very, very important to making sure that your investments are going to do well. Thanks for watching. So what it generates for their business, I don't know, just a feel-good thing and a bit of a waste of money. But if you look at BHP and their share price, it's trading at about the same level it was in 2005. So 10 years later, we've got a share price of $25, same as it was 10 years ago.